financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it.
Welcome to Financial Fitness. I'm Jess Tyler along with the Money Doctor, Dr. Francis Rayam. Good morning.
Good morning, Jess. How are you?
I am excellent, and I'm excited about today's show because you have brought along a guest.
I'm really happy to have him back. So Ben has been here with us before, but yes, we have Ben Braverman from SMS Financial Services. So welcome, Ben.
Hey, good morning, Francis. Good morning, Jess. Nice to see you guys again.
So I would say that Ben and I work together a bit. He is a guy that is not in sales. So just so people know, if we're talking about this topic today, he's not selling you anything. He's not giving you advice. He's an expert in this area. And because of that, I often call him and have a working relationship with him about, what is new in the area, what's new in the industry, what might be the best product for somebody. Maybe I have a really complicated case and I want a second opinion on it. And I might call Ben, and he might involve other team members, including, JDs, attorneys, accountants, whatever. And together we work as a team to try and find the best solution for people. So we're going to be talking about annuities today, but maybe a little general chit chat about them, but in specific, a special kind of an annuity called a fixed indexed annuity. So Ben, would you tell your side of the story about what it is from your desk when I call you and what kinds of things you do that help us?
100%. So I work with financial advisors all around the country, and I advise advisors on things from marketing to business development, and a lot of it comes down to product, like fixed index annuities, with or without certain riders. And as I understand it, we're going to dig into guaranteed income a little bit today as well. We work together to make sure that her clients are in the best strategies, the most appropriate strategies that are going to give them the most amount of upside relative to their goals, be that capital preservation or guaranteed income, which is typically where a lot of people near entering retirement find themselves.
Yeah, I would say that since I'm an independent broker and I don't work for one specific company, what I'm looking to do is get the best I can from any company for my clients. So I rely on experts in the industry rather than saying, I know everything, I'm omnipotent, and I don't need any help. We are going to talk about guaranteed income, but also things that make specific indexed annuities, even though we won't mention company names, but there are specific products out there that really have unusual features that are very helpful to people. If you typed in annuities or even fixed indexed annuities into the web, you would get so much information. But that doesn't necessarily mean it's the right product for you or the wrong product for you. It has to do with your specific situation. So let's start off about talking about why somebody in an environment where CDs are at 4.5%, 5%, and people are saying, so I'll just get a CD. Why would somebody want to buy an annuity that offers fixed income, guaranteed income for the rest of your life?
Yes, right now you can go down to your bank and probably get a 5-year CD in the neighborhood of 4 to 5%. That's a reflection of the really high interest rate environment that we're in. Why are we in a high interest rate environment? There's any number of economic reasons, but the result of that high interest rate environment is that, yes, you're finally seeing some decent yield at the bank, and that's great, but it's only potentially for the next 5 years. Also, if you put non-qualified or post-tax dollars into that CD, you're going to get taxed on it every single year. Furthermore, indexed annuity companies, which are insurance companies, have access to an enormous inventory of AAA rated corporate bonds. And when you buy an indexed annuity, they take about 87.5% on average of whatever money goes into that annuity, and they buy AAA rated corporate bonds. So if you're seeing 5% at the bank, in all likelihood, either through income, which can be reflected as effective yield, or participation rates inside of indexed annuities, you could actually potentially make in excess of 5% and still beat the bank. So for that reason, like a lot of things, what's in the window of the local credit union or advertised by the bank might look attractive, and it certainly is. But if you go out to an independent broker like Francis, there's a good possibility that she can find you something either more long-term or short-term that could also offer a higher rate of return, because it's leveraging the same interest rates as the bank, but it's going a little bit farther with some more advanced options pricing, as well as some different strategies like guaranteed income. Mm-hmm. So would you rather 5% for the next 5 years or 5% plus for the next 10, 15, or even 20? And what that 5% actually looks like can take some different forms, but effectively, if it's moving the needle in your retirement, that is the goal for these different strategies.
So here's an example. There's a product that I like to use that offers something called an income rider. So the fixed indexed annuity could work just like any other investment vehicle where you put X number of dollars in, and if the market does well, it makes money, right? Now, in fairness, if the market does poorly, that account may have protections, principal protection, so it doesn't lose money. That's nice. But what I like to use that product for is the income rider. It still gives you that principal protection I'm talking about. So you're not going backwards. When the market takes a tank, you might have a 0 year, but you're not going backwards. But what it really does that I love is if you buy that income rider on that specific product, it gives you a bonus upfront for income purposes and a guaranteed rate of return, a guaranteed roll-up, an interest rate essentially, for the 10-year timeline, or when you turn that income on, whichever comes sooner. And when you turn that income on, that can guarantee your income for the rest of your life. And when you die, whatever's left over can still go to a beneficiary. That product right now at the time of this filming is offering 30% bonus, which is enormous. So if you put $100,000 in there, $100,000 becomes $130,000 overnight for purposes of income. You're not walking away with that in cash. But when you turn the income on, it's based on that $130,000 plus, in this case, an 8% per year guaranteed roll-up for 10 years or until you turn income on. So there's a handy-dandy little calculator that I can show you. It's open to the public. I can't give the name of it right now, but I can show it to you, and you can pop any number you want in there and see every year what that income column will have grown to. And that is the number that they're basing your lifetime income on. So in most people's cases, they aren't going to take out their $500,000, $4 million, whatever it is, in a lump sum at retirement time, because they're going to get hammered on the taxes. Most people are taking it out as a stream of income. And I know Ben and I like to talk about this like it's like privatizing your pension. But I'm going to ask Ben what his take is on why that might be so appealing right now, not just with a bonus, but with an 8% rate when CDs are maybe at 4 or 5.
So you mentioned somebody puts $100,000 into product A. Product A has a 30% bonus and an 8% compounded roll-up. For the consumers out there, what does that really mean? Well, that means that if you're 60 years old and you put $100,000 into that strategy, if you want to take income after 1 year, you're going to get something in the neighborhood of $6,700 a year guaranteed. So what is that? That is 6.7% of your purchase payment guaranteed for the rest of your life after 1 year. Now, why do most people purchase CDs? Most people purchase CDs to pull the interest. They either are using it as a safe money solution for accumulation, but the way a lot of retirees use CDs and the way a lot of financial advisors who may not leverage annuities talk about CDs or fixed income is we're going to pull the interest. So you're going to take 5% from your CD, interest only, and that's going to be your income. So again, you want 5% for maybe the next 5 years, because interest rates might go down, and then what's going to happen to those CDs? The rates are going to go down. So you're only going to get 5% for the next 5 years. With just one of these strategies that Francis is alluding to, you could effectively get 6.7%, $6,700 out of a $100,000 initial premium inlay, 6.7% for the rest of your life, guaranteed. And because of the innovation in the index annuity market, there's a lot of strategies now. Well, there's some strategies that also will give you the potential to retain your premium, or what's known as your cash value. But that's not necessarily guaranteed. However, ultimately, if you're purchasing a CD to draw the interest, why would you not take 6.7, and that's just waiting 1 year for the rest of your life. So if you're 60 years old, you're going into a CD, you're getting 5% for the next 5 years. Great. Then after 5 years, interest rates are back to what, 2-3%. What are you going to do now? On the other hand, right now, income is on sale through people like Francis. So you could get 6.7% for the rest of your life. You could even get, think about this, if you defer a few more years, that same annuity, and I'm going to go ahead and say annuity because I don't think it's a bad word. I think these are fantastic, productive strategies. You could take as much as $10,000 guaranteed from $100,000 in premium. So now that's 10%. My apologies. That's 10% of your initial premium, right? So if you're getting 10% of your initial premium, now you're looking at effectively 10% of purchase payment, which is a great way to talk about guaranteed income because it's a little bit easier to understand. That means in 10 years, you're going to get all your money back. Find me a CD where you could draw 10% interest for your entire life.
Yeah.
Is there a price point though that you would recommend getting into an annuity at? Like you're mentioning 100,000. Say you had 10,000. Is a CD better at that point, or still annuity would be better?
Right. Or go ahead.
Yeah, it's not that one is better than the other. It's that one might be a better choice for you than another. And I would not say that there's a price point where it makes more sense than another, but I might change my advice to somebody based on that. For instance, if they only have $10,000, the income on that is going to be very small. It may not be worth them paying for an income rider. And many of these products have, a $10,000 or $20,000 or $25,000 minimum. But it's very unlikely that somebody with $10,000 is saying, here's my retirement nest egg. What am I going to do that's best with it? At that level, they're still trying to figure out how am I going to save for it? And I do have some advice about that, a suggestion about that. Another kind of product that might be a good fit for them that we can talk about in the second half too. But in this case, I just want to remind people that when Ben is giving those numbers, it's probably straight off that calculator I'm talking about. And he's talking about a 60-year-old person the next year. When most of my clients are saying, oh no, I want to retire at 65, or I'm happy working still part-time, or I want to do it later. Now, the older you get, the higher that income is going to be for two reasons. One is that you've deferred it longer and you're grabbing 8% a year on it right now, compounded, plus that bonus we talked about. And the second is that the government tables say you'll live less. You'll live a shorter period of time. So they have to pay out your money over that lifetime, which means your payments get larger. It's very easy to illustrate this for anybody that's considering this idea and is just afraid of the word annuity or fixed indexed annuity. Sounds even more complicated. It's like 30 seconds. I can show you whether this is what money is going to come out of your retirement nest egg doing this part of your retirement nest egg. And before we go to break, I want to make that point. This is not for all of your money. Nothing should be for all of your money. It's a tool. It's a strategy to use. It's a great one. It works very well for retirees, especially anybody interested in safe money and unsure about what's going to happen with the market, because I'll tell you what, you might want to wait and say, well, when my CDs are done, then I'll look at this. But let me tell you something. When the CD rates drop, the annuity rates will drop too. So if you want to do this, you should think about it as early on as possible in this environment when exactly what Ben said, probably the one takeaway from this is income is on sale right now. And that's the way to look at it.
Okay, perfect. We'll get into more of this with the second half. It's a really great conversation. Ben Braverman and Francis Ram, the Money Doctor, part 2 of Financial Fitness, coming up next on WHMP. Welcome back to Financial Fitness with the Money Doctor, Dr. Francis Ram, along with a special guest.
We have Ben Braverman from SMS Financial Services. Welcome back, Ben.
Hey, Jess. Hey, Francis. Happy to be here. Thanks for having me.
Our pleasure. So during the break, we were talking about things that I wanted to get on the air. So can I ask Ben to just repeat the kinds of things he was talking about as a start of this? And then I want to talk about a product that might suit somebody in the situation you were talking about, Jess. One of the reasons you like to talk about the payout a certain way is to make it easier for people to understand. Can you explain again how you think about that?
100%. So we talked about this a little bit in the previous episode, because right now, CDs are finally really attractive. Banks finally had to give in, right? For the longest time, you were getting 25, 50, 75 basis points, which is just something that people in my industry do obnoxiously. All that means is 0.5%, everybody, in a CD at the bank. Now you can get something in the neighborhood of 5% for 5 years, which is great. But what we were talking about is there's strategies via index annuities where you can get guaranteed income for life. And if the purpose of buying the CD is to pull the interest for income, which is what a lot of consumers are doing, then consider this. Oftentimes with strategies that Francis has access to, you can get 5 or 10% of your initial purchase payment back in the form of guaranteed income. For easy math, let's say that you give $100,000 at age 60 to XYZ carrier. That XYZ carrier, 5 years later, gives you a $10,000 a year paycheck, regardless of whether the market is up, down, or sideways. And if you buy it now, if you put that money into it now, regardless of where interest rates are for 5 years. So 10,000 of 100,000 is what? 10%. So if you think that, as a lot of consumers do, if the goal is to pull the interest from the CD to supplement Social Security or a supplemental retirement income, then through an indexed annuity, you can actually get effectively a 10% yield or a 10% return in the form of guaranteed income, 10% of your initial purchase payment for the rest of your life. When we think about 10,000 as part of 100,000. And that's really, really attractive. And guess what? 5, 10, 15, 20 years out, regardless of where interest rates are at, and regardless of where the market is at, you'll still get that $10,000 a year paycheck or what have you. So as attractive, and furthermore, the reason that the insurance company can afford to do this is because they have access to AAA rated corporate bonds that banks have some access to, but to not the same degree. And for that reason, they have even higher yields that they are able to pass on to the consumers, just like the banks, but in the form of more long-term strategies. So 5% for 5 years or 10% for the rest of your life.
Yes, I think Ben has reiterated that point perfectly, but one of the questions I get is, well, how is that possible? How can they pay a big bonus like that and then this guaranteed income? Something must be wrong. How are they making money? So I would like to say Ben's just pointed that out. First of all, they know how to make money probably better than the average person. That's what actuaries are for. They have access to wholesale pricing, which we don't have access to. And of course, there is a surrender charge on these kinds of annuities, much like you to have a penalty if you pulled your CD money out early. So that's pretty parallel, right? They're going to feel a lot like a CD because they're safe money. They have surrender charges if you pull too much out early, but they have great liquidity. Even if you're not turning the income on, that specific product I was talking about, you can get 7% after you've been in it for a year, 7% of your balance without a penalty from the company. That doesn't mean you're not going to pay taxes on it, but it does mean you may not even turn the income on yet. You might take that 30% bonus, 8% roll up, and 2 years from now say, I want a little bit of money, and take your 7% out and leave it there for the future, leave the rest of it there for the future time when you're going to finally turn the income on. So there's several ways to get your liquidity out of these things. It's not just stick your money in there, make a choice for income today, and you're stuck with it. In fact, this particular product, you can actually turn the income on and off, something that's probably too complicated to get into right now, but that's a very unusual feature. Let's say that you're thinking of retiring, you decide to turn the income on, and 2 years from now you say, no, I want to go back to work, I miss it. Well, now you've got so much income, you don't need the income from the annuity. Why take it and pay the tax on it if you can defer it further? So you turn the income off again, right? And then a couple of years later, you could turn it back on. So there's a lot of flexibility to these. When I think most people have the idea that if you have an income generating annuity for life, it is the old fashioned kind where it's just a fixed annuity, an immediate annuity where you buy it, you put a lump sum of money in, you get the income for the rest of your life, and you have given up that asset in order to do that. That's the kind of thing we used to use for nursing home avoidance and things like that. We hardly ever use those kinds of annuities in my practice any longer. So the next thing I think people would say is, well, what happens to my money when I'm gone? You know, in my CD, I put a beneficiary on it, so I draw the interest, but whatever's left goes to my beneficiary. And I'll ask Ben to talk about that, just to give him equal time, about how in this specific product, and I do want to save a couple minutes to talk about the solution for Jess's client that she mentioned.
So yes, to your point, we're in the golden age of annuities. We're in the golden age of innovation with respect to annuities. So it used to be that an income annuity known as a SPIA, which isn't a bad strategy, it has a place just like a
Right.
CD has a place, just like exposure to the market has a place. Everything, I am not an all or nothing consultant. While I consult specifically on annuities, there's a place at the table for a lot of different strategies to have a fully diversified retirement portfolio. That being said, these old income annuities, you essentially were giving your money to the insurance company in exchange for a guaranteed income stream, not unlike a pension. But a pension, insofar as when you died, other than maybe your spouse being able to take over that income or pension, there was no real asset left. And that's what makes the strategies that, for good reason, Francis is especially bullish on, so compelling and competitive. I call it G plus A, guarantee plus accumulation, which is the ability to have an unequivocal guarantee of income, as we discussed earlier, be that 5% of purchase payment, 10% of purchase payment, 12% of purchase payment, but also have some underlying indices that should generate a rate of return. So after 10, 20, 25 years, even after you've been taking that income stream, you still have real cash value. And what is that cash value? Well, number one, Francis, it's cash.
Right.
It's money that you have access to.
Yeah.
So with less than 25% of retirees having some type of long-term care plan, it's money that in case of an emergency, to Francis' point, you could turn off the income and use it to supplement some other unanticipated expense in retirement. But what else is it? It's legacy. It's real cash value that your designated beneficiaries, be that your children, your church, your charity, whomever you want it to be, will get whatever is left in that cash value account, that A account, that account value, even while you're still getting that guarantee, that'll go to your beneficiaries.
Yeah.
So it's a fantastic combination because it satisfies two major concerns in retirement, which is outliving your assets and also an inability to leave a legacy. So this marries the two together. And on the one side, you're guaranteeing that you're not going to outlive the asset. And on the other side, as long as we get a decent rate of return in the indices, you have a good possibility of still leaving a legacy.
Yes.
Will the beneficiary in that part, would they get a lump sum of what was left, or would they get the guarantee?
They would get a lump sum, unless the beneficiary, there is something called a joint income benefit, Jess, where I could say, you know what, I want to make sure that I'm going to buy this strategy with my retirement dollars, and I'm going to make my wife a joint income recipient of the income. So if either of us passes away, the income stream continues. So if it's $10,000 and I die, she continues to get a paycheck for $10,000 or vice versa. Then when we both pass away, unfortunately, whomever our beneficiaries are, which in this case, you know, whomever that may be, they'll get the remainder of the cash value. But you can only, just to clarify, there's no strategy out there that will continue an income stream to your children, but there is ones between spouses. That's just how it works right now.
Yeah, that was a really good question, Jess. I know that we're getting short on time, and I promised to address the question you had about what if somebody had $10,000 would this be the best kind of a product for them with this income rider? And I would say, in certain circumstances, maybe, but probably not. With a smaller amount of money like that, we might opt for a different kind of an indexed annuity or a different kind of product altogether. It might be something else completely different. But I like to use two products in combination with one another very often for people because they offer different things. And so for somebody with, say, $10,000, maybe they have $10,000 over here and other money over here, I might use these two in combination. And the second product I'm alluding to is also a fixed indexed annuity, but rather than buy the income rider on it, I might use it because it has an upfront cash bonus. The first one we talked about had a bonus, but it's used for income purposes. This one would be used for cash. So you put your $10,000 in, and if it has a 15% bonus, immediately it's worth $11,500. And then you'd have the earnings based on the market. But it also has, that particular product also has liquidity in the first year, which is very unusual. So remember when we started talking about this, I said, this is not a one size fits all. I didn't say it, but I paraphrased it. It's not a one size fits all product. We use different kinds of products for different solutions, but we very rarely come on the air and talk about specific things. These were too good to ignore, and I wanted Ben to come on and share this with everybody. But you could get, for instance, in that annuity, if it's liquidity you're worried about, like I'm putting this in a money market account because I need it to be somewhat liquid, I might need another $1,000 this year. Okay, you could get 5% of that contract out in year one without a penalty from the company. And after year one, 10% per year. So you have some liquidity. Could you take it all out? Sure, but you would suffer the surrender charges on anything over your free withdrawal. But the same sorts of things. These products go to your beneficiaries. Maybe an important point for people is that annuities avoid probate. They precede your will. In case that bears repeating, the money goes directly to your beneficiaries. It doesn't get stuck in a will. Now, when might that be extremely important? Let's say you're leaving somebody some property. All my money's in my house. I'm going to leave my house to my kids. Well, who's going to pay that mortgage if there is one? Until this money gets freed up. Guess what?
And that takes a long time.
It can take a long time. And those annuities might generate the cash or the income in order for them to be able to survive and not have to do a fire sale on that house that you thought was your biggest investment. So
yeah, that definitely is much more attractive.
Yeah, lots and lots of reasons to use different products. Obviously, today we're talking about fixed indexed annuities, but obviously we use everything we can to try and make a good plan for clients. I would just ask Ben for any last words, anything we didn't talk about that you think we missed and was important for this show, Ben.
I would recap that we're in the golden age of annuities, that in this high interest rate environment, insurance companies have more yield. And for that reason, whether it's $10,000 in a scenario that Jess outlined, $100,000, $500,000, 50 to 60% of your portfolio for most retirees, you should have some type of risk mitigation, be that you're mitigating legacy risk, be that you're mitigating market risk or sequence of returns risk, or mitigating longevity risk, i.e. outliving your assets. And there's a lot of different annuity strategies to address that. But just like you don't want to have FOMO about missing out on that
fear of missing out, right?
At the bank, the last thing I would want is retirees 5 or 6 years from now, when interest rates come back to earth, to think, shoot, I could have gotten myself either a really, really great private pension in retirement in the form of guaranteed income, a really, really strong long-term accumulation strategy as a complement to the market, something a little safer, or a really, really good legacy strategy. Because as much as a consultant, I wish that the strategies we're looking at right now will be exactly the same 5 or 6 years from now, just like the bank CDs won't. I hope consumers don't miss out on this amazing buying opportunity.
Thanks, Ben. So I just want to thank Ben Braverman from SMS Financial Services again for joining us, and I hope you'll come back again.
Well, let's get your phone number, Francis.
Thank you, Jess. Also, one last time, Ben is not a salesperson at all. He's here as an expert, and we thank him for that. My phone number is 413-773-3333 here at Hug Your Money.